In the case of these, watching Silicon Valley Bank's customers waiting outside the bank, these are high-tech investors, and they're waiting in lines to go get their money physically. What does that tell you? Maybe they put some of it under the mattress, when they came out. So deposits are leaving the system, interest rates up 20-fold in 1 year. This is a major, major shock. And it doesn't seem to me that the Fed is acknowledging that the banking system is under duress here.
Cathie Wood, head of ARK Investment Management, thinks regulators missed problems in banks like Silicon Valley Bank because they were too focused on cryptocurrencies. U.S. regulators have paid close attention to the cryptocurrency sector in recent months, warning banks away from providing services to the industry and arguing that many cryptocurrency services needed to comply with U.S. securities regulations. Wood claimed on Twitter that the cryptocurrency sector held up amid the crisis. While the U.S. banking system was seizing up in response to bank runs threatening regional banks, Bitcoin, Ether, and other crypto networks didn't skip a beat. Wood tweeted, "Regulators should have been focused on the centralized and opaque points of failure looming in the traditional banking system rather than on decentralized finance and cryptocurrencies," Wood argued. "They should have been all over the crisis that was looming in plain sight, asset and liability duration mismatches," she continued. In this video, Wood and Art Laffer, an American economist and author who first gained prominence during the Reagan administration as a member of Reagan's Economic Policy Advisory Board, discussed the banking crisis, the failing financial system, the Fed's increasing rate hikes, and the general outlook of the economic and banking system.
I began getting concerned about how rapidly the Fed was raising interest rates because I saw credit default swaps, so insurance policies against bankruptcy. I saw credit default swaps moving up for banks broadly last spring.
Yes.
And this is as they started, as I think the markets began to understand this Fed was going to start raising rates at a very rapid clip. And then the yield curve inverted in July of last year. And that was another signal that not all was right out there. The bond market was signaling something. And I know you didn't agree that I should have written an open letter to the Fed in October. But the reason I did that is I feel as though there's no debate taking place. Maybe there is, and they all decide unanimously. Right. And all I was saying is, look, credit default swaps are going up. This is insurance policies against bankruptcies in the banking system. You've got an inverted yield curve. You've got commodity prices coming down. You have the gold price actually peaked in August of 2020, and it is in a range. And then, of course, it broke that range. So I was just raising the question about how can you be unanimous when there actually is some conflicting data out there that you should be sharing your analysis with us? Like, how are you responding to this? And so that was more the spirit of the letter. And then I basically said, okay, we've said our piece, and now around this banking crisis, I think all of those variables, the credit default swaps, inverted yield curve, were pointing to two mistakes, two mistaken assumptions in the banking system. So I'd love to get your reaction to this. One was that during COVID, when we were worried about a depression, that a lot of banks that were being flooded with stimulus payments were taking that money and investing in safe securities, their government-backed mortgage securities, treasuries, and everything. But they invested long-term, put in the held-to-maturity category. And in the case of Silicon Bank, they were earning really 1.6% on that book. So what was the assumption they made? They made the assumption that, gosh, we're probably going to be fighting a depression here. And surely interest rates are not going up anytime soon.
Correct.
So that was the first mistake. And then the second, and it was a pretty good assumption, because we've never had now it's a 20-fold increase in interest rates in less than a year. If you go back to Volcker, it was a 2-fold increase, 10 to 20%, that shocked the system. And what I like to say is, the system is being shocked, because more so than in the early 80s, because we had 2 weeks ago an inversion in the yield curve of more than 100 basis points. So more than 100 basis points on 4% is a lot different than more than 100 basis points on a 15% interest rate. So I've likened it to the Richter scale. So back then, if you look at 4% over 15, that's 6.5 on a Richter scale in terms of earthquake. If you look at 1% on 4%, or 100 basis points on 4%, that's a, well, what is it? That's a 25 on the Richter scale, which is 4 times.
According to Laffer, there's a serious problem on the financial institutions because of the Fed policies, and also because of fiscal policy. I think there are a lot of cracks in the system, and I think we're just beginning the financial problems, because you're going to see this pop up in all sorts of other areas because of leverage and because of a very sharp rise in interest rates. Let us continue with the video as Cathie and Art break down the bond market yield curve and what this means going forward.
Now into quantitative tightening, so they're actually selling, and yet the Treasury bond yield has gone down since last October. It peaked at 4.3%. Now we're at 3.6%. And I've always thought, bondholders have to be the most focused on inflation. Long duration. Right. We should as well. And we manage long duration assets. And, the 21 and 22, as fears of inflation and interest rates were rising, were just killers for long duration assets. Last year, the bond market, last year was the worst year for the bond market since the 1780s. So we have never had a bear market in bonds like that. Now, that is turning around, and we've seen the long-term treasury go from 4.3 last October to 3.6 roughly. And the way I look at it, a bond investor is trying to protect himself or herself from inflation. They're trying to protect. And so that market, I believe the TIPS implied inflation rate is it about 2.1 or 2.2?
Yeah, something like that. It's very close to that.
Yeah. Is very close to that. And so, and it hasn't deviated very much from that. I think it got to, 2.5 or 6, something like that.
All of the variation has been in the expected real yield, all of it, which is exactly what you're saying.
Right. So why do you think the whole structure is so
let me
low?
Let me try to give you an answer to that. And remember, I'm far from accurate. I make lots and lots of mistakes, so please forgive me. But this is the way I see the issue right now. Is yes, the Fed has been enhancing the supply of bonds in the open market, which you would expect that would cause the price of the bonds to drop and the yields to go up. And they've done just the opposite of that. They've gone way down. The reason I think of is there's a flight to quality. That people are worried about banks. They're worried about really having their deposits guaranteed by the Fed. And so as they fly to things, they go out and buy the bonds themselves rather than holding a bank's assets, which then in turn buys the bonds. And so they feel much more secure in the value of their assets. And so that increased purchases has dominated the supply effect of the Fed trying to run off the balance sheet, lower their balance sheet, which is still very, 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 very large, running it off there. And so it's more than offset it and caused the price of the bonds because of panic buying of government securities, which has pushed the price of the bonds up and that yield curve down. But once they've stabilized, once you've got all the panic buying of those bonds out there, and you can really do a great deal. Let's say you've got $10 million in deposits as banks. You can get a very nice yield by owning government bonds, short-term government bonds. There are all sorts of bond funds that you can own, and still get a damn good yield, maybe a 3.5% yield on those, and have it almost as liquid as cash. You can get your money out of it in 3 days, and it's government bonds. So there's a natural, for if there's any sort of smell of fear, they'll go and buy these. So that, I think, is what's really caused the rates to drop so sharply. It's not because of the Fed selling bonds, and it's not because of inflation. It's because of, my God, I'm not going to get my money back from a bank. And this is the equivalent of those friends of yours out in Silicon Valley Bank. Oh, give me my money, give me my money. That's how they get their money out, and then they put it in these short-term bond funds.
One of Wall Street's most closely followed recession indicators has hit highs not seen in more than 4 decades. While this signal doesn't inevitably lead to the economy contracting, every recession since 1955 has been preceded by the dreaded yield curve inversion. This rare phenomenon occurs when investors demand a higher rate of return to lend the federal government money for just 2 years rather than for a longer period of 10. Normally, the opposite is true. The immediate reason that fixed income investors are currently so bearish about the outlook for the U.S. economy is the increased fear signal from the Federal Reserve. Stockholders should always have an eye on the bond market for 3 reasons. First off, ultra-safe treasuries form the minimum risk-free rate an investor can expect, upon which all asset prices ultimately derive. Second, bondholders more accurately predict fluctuations in the economic cycle, since corporate earnings typically lag. Third, its size is enormous, with $615 billion worth of treasuries traded every day, excluding other fixed income products like corporate debt and mortgage-backed securities. And the greater the liquidity, the more meaningful a market signals. What do you think of these insights from Cathie and Art? Let us know in the comments section below. Don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.